Hello, welcome back. We have long talked about these companies that don't really make any profit. A company of that sort would be Palantir, for which you have to be super careful because as we are entering a bear market, like a full blown bear market right now, these are the ones that are going to be massively beaten down. Again, because they are not making profit and they are, the easiest to sell for investors. And so if you take a look at Palantir and go back to the max chart, you'll see that the company had a period where everybody was buying and then it reached like near 40 or so. And then it started going down and down and down and down. And right now we're looking below $8 in the pre-market value actually. And if you take a look at the 1 year high, it has been like near 30. Again, this is at least 70% from highs right now, based on the 16% loss that we're currently looking at. And the company reported earnings. Let's see what they did there. You will see here that they announced financial results for March for the quarter ending March 31, and the total revenue grew 31% year over year. Commercial revenue grew again, and US commercial revenue grew as well. And in the previous years, you may have seen companies just growing their revenues and gaining on that. But right now, again, as we are entering or as we're entering a massive bear market, we want to be seeing companies that are actually making money, not just increasing their top lines. And you will kind of see that all of their revenues here have been increasing again, but then again, loss from operations of 39 million, representing a margin of 9%, of a loss of 9%. An adjusted income from operations of 117 million. Cash from operations 35 million, adjusted free cash flow 30 million, and net loss per share of 5 cents, and adjusted earnings per share diluted of 2%. Okay, so as you'll see here, the company is also guiding to a base case of 470 million in revenue. A wide range of potential upside to the guidance is what they are saying. And for the full year 2002, they continue to expect an operating margin of 27% and annual revenue growth of 30% or greater through 2025. Now, in this kind of news, again, the stock could have gone up massively if we're talking about the previous bullish years. But right now, we are in a period where people actually really care about what they should in the first place, and that is net income, that is free cash flow. And we're going to take a look at what the company is doing in regards to that and not just sales. Now, the PE ratio here is negative, and negative PE ratio points to a company that has been losing money, has been losing net income. And price to free cash flow is high, but at least it's not negative here. It used to be negative. And outstanding shares, the company has been massively diluting investors, issuing more and more shares, trying to take advantage of the previous highs, selling shares through that period. And the free cash flow to total liabilities ratio is kind of low because the company again has been having quite some free cash flow when compared to the total liabilities. Seems that they are fine in terms of that. We will discover that in more detail when we take a look at the financial statements, see exactly what kind of total liabilities they have and exactly what kind of free cash flow they are making. Now, the 5-year revenue growth has been growing, of course, massively, and the company is expecting it to be growing nicely throughout 2025, is what they said. And the 5-year net income growth, though, has been negative all over these 5 years. Free cash flow growth getting a little bit into positive territory. We'll examine how that happened. And 5-year total equity growth also increasing from being negative to about 2.3 billion, and 2.3 billion is the case, yeah. And this has a lot to do, of course, with outstanding shares having been increased and the company funding themselves through that. Now, the debt of the company seems to be low, but all the returns here are massively negative, a very bad sign for a company. And if we take a look at the financial statements, you will notice a company that, of course, has been able to sell better and better, from 500 million to 1.5 billion here. But look at this net income, from minus 580 to minus 520. So practically speaking, the company has been at the same level since 2018 and still losing tons of money here. Now, if we take a look at the balance sheet, you will see that the total equity has been increasing, and that has a lot to do with additional paid-in capital, of course, because the company has been diluting investors massively and printing more shares, and this is how they are making their money. And so operating net income that is beginning from a negative standpoint here, as you'll see, and then net cash provided by operating activities, which becomes negative because of stock-based compensation added back to the free cash flow statement, to the cash flow statement, because it's not a cash expense. And so this is what drives the free cash flow in positive territory. Cash from investing activities is in the negative. The company has been investing a little bit, and financing activities, getting debt every year pretty much. Other financing activities is what the company is doing, pretty much getting more debt and issuing stock as well. So the free cash flow of the company has been negative, and it's only this year because of a lot of stock-based compensation and a little bit of a reduction in terms of how much loss they had in their net income is what happened here. So we're looking at a company that's basically not profitable at all. It's losing money hand over fist every year. And so is there a price to pay for this? So we're expecting the company, they said, to be growing at about 25% a year. So we're going to go high. We're going to go 20, 22, and 24 here. Net income margin now here, you will notice that everything is negative because the company is not profitable. So what can you do about this? You have to be marginally profitable, project the company to be marginally profitable, because if you are using negative values, you are going to be getting negative estimates because the company is not making any money. The discounted cash flow model won't actually come back with anything that makes sense. And so you need to be entering marginal profitability, which we don't even know if the company is approaching. But we need to do it for the sake of the model. So I'm going to go 3, 5, and 7 here and see what we'll get out of that. And the free cash flow margin that we're going to aim for is something typical, 80, 90, and 100%. Now, this won't affect our projections a lot because our net income margins are low to begin with. And net annual return is what I typically want to be making a year from my investment here. And if I hit calculate, you'll see that we're looking at a company that is basically almost close to a penny stock right now. Very little worth here compared to what the company is making, and we're already projecting it to be net income margin positive very soon, while that doesn't seem to be the case. And even at this kind of revenue growth, we're looking at a company that is not even worth its current price, which is about to be $7 or close to that when the stock market opens. And when I did this video many months ago, maybe 3 or 4 months ago, I'm pretty sure I had similar values here, similar projection results. And back then the stock may have been 20, 25, I don't remember. But you see now how a company is not doing well in terms of financials can really affect it in the long run. And even if their earnings report is not like horrible, they are still down 20%, and that's because they have been massively overvalued to begin with. The stock price doesn't make sense based on what they are doing financially, and this is why they are completely battered down. They are losing tons of value pretty much every day, and this is probably expected to continue, especially in the current environment. So this is what's happening with Palantir, a very overvalued stock. Be careful about it. And even though I like the business and the what they are doing, I have to be super careful about owning this one, and I wouldn't approach it in the current time. Thanks a lot for watching. Tell me what you think about Palantir, and leave a comment below. And please remember to leave a like also and subscribe in the video, in the channel. And thank you for watching this one again. I'll see you in the next one. Bye bye.